The stock market is in turmoil right now, and a lot of investors are quite reasonably spooked. As a former mutual fund and hedge fund analyst, I'm going to be sharing my perspective and analysis on the current situation and try to get into when this fire sale could potentially turn into the investing opportunity of a decade. I'm going to analyze current stock valuations within a historical framework, discuss the changing landscape of Wall Street estimates, and share my perspective on what shape the economic and investment recovery could take. Ready? Let's get into it. The last peak for the S&P 500 came on January 3rd of this year. Since then, the index is down 21.5%. Now obviously, it's not wonderful for investors, but it's not exactly like years of gains have suddenly been erased, as this only puts us back to levels we were at the spring of 2021. One way to gauge how bad things could get for the market are to compare it to the previous US bear markets. The mini crash from the initial COVID pandemic saw us down 34%, while the fallout from the dot-com bubble and the great financial crisis took us down 49% and 57% respectively. We'll get into the economics and valuations later on, but the thing to be considering here is, on a relative basis, how does the current state compare to those times? If you think this is going to be Great Financial Crisis Episode 2, Inflation Strikes Back, then yep, things could get a lot worse from here. If you think the Fed efforts will bring inflation to a moderate level, and once we get on top of this oil situation, things can get back to smooth sailing, then likely there's not much more pain left to come. Another thing to consider when looking at max drawdowns from the S&P's peak is how long it took to reach that bottom. The slow grind after the dot-com burst took 638 trading days, or roughly 2.5 years. If we have that in store for us, that means another 2 years of declines. As we'll discuss later though, valuations there were at a whole nother level compared to today, and the growth sustainability of the current crop of companies on the S&P 500 appears to be much healthier. So it's my belief that things definitely aren't headed that way. Basically, if companies continue to exhibit strong growth, it's very unlikely the market will suppress valuations to record lows. In my view, the current situation has little resemblance to the dot-com bubble or the GFC. Those were some very dark days. What's perhaps better is to compare the current situation to other significant market pullbacks over the last 30 years, of which there were really only 4: 1998, 2015, 2018, and the COVID pandemic. Compared to those periods, we've already taken longer to bottom out than 3 of the 4. Well, 2015 was nearly a year-long slog, but ultimately, the bottom was much softer. What's interesting is that I think all of these, barring the COVID shock, have analogs that are relevant to today. The 1998 market correction came after a period of incredible growth for the S&P 500, up 236% since the start of the decade, or a 15.2% annual return. The global economy was rife with significant concerns, however. The market weathered the Asian crisis well enough, but when the Russian ruble crisis hit, investors called it a day, took profits, and headed to the bomb shelters. Exogenous international shocks following a period of strong returns? Yep, that's applicable to today. The takeaway for me here is that this abated relatively quickly, with the market discounting the worst case scenario after the global economy proved to be a lot more resilient than expected. Right now, the market has a lot of things to worry about. Foremost is oil and inflation. A good thought experiment though might be to think about how the market would be performing if oil was back at $90 and inflation solidly trending downward. I think that would be enough to bring some of the exuberance back, and while I'm not saying we're on the cusp of that, my view is it won't take years to accomplish, and the stock market will certainly precede these improvements as it always does. Next, 2015 was more of a market languish, which definitely we've seen in part. Nothing was broken, but after an incredible run out of the great financial crisis, everyone and their mother was out there calling for a correction. Nothing really fixed the situation, but more and more investors bought into the idea that the economy is fine and watched as corporate earnings continued to grow. The relevance to today is that even if the economy gets back on track in short order, it could take a while for investors to really buy into the story. On the bright side, when this happened, the market mostly traded sideways and the bottom wasn't too painful. If we have this in store for us, even being too early to call the bottom won't be too painful. Personally, I'm of this mindset. I don't think we're headed towards anything close to a dot-com or GFC style pullback. More pain could come, but the bigger risk is that we just trade sideways for a while until the economy proves itself in earnest. What matters is how companies fare, and as I discuss a bit later, it seems like estimates for continued growth for the S&P 500 are relatively robust. Next, the 2018 correction is an interesting one in how it relates to today. Back then though, inflation was manageable. There was record low unemployment like today, and strong GDP growth, so on paper everything was pretty decent. Trump did have a bit of a trade war brewing with China, but arguably the big concern was, the Fed being too aggressive. With muted inflation and what many considered some dark clouds forming on the economic front, the hikes seemed needless to many, which led to a bit of an outcry that the market had topped out. Only when the Fed moderated its policy maneuvers did the market surpass its previous peak. But even then, it took over a year and some Fed cuts for the market to truly stop trading sideways. Takeaways? Well, the Fed is going after inflation pretty hard, and likely won't chill out until after inflation is manageable or we see something else worse pop up, like say a housing market blow up. So, if you're bearish and think things will follow the 2018 playbook, then things really won't start to work again for the market until we see some indication that the Fed is about ready to hit the emergency brake. Okay, so price levels are one thing, but the underlying valuation is important to fully understand where the hard bottom could be found. Currently, the S&P 500 is sitting at around its average since the end of the last century. But beyond price, the other element of PE, earnings, shouldn't be considered a static thing. What's interesting though, is that over the course of a year, while the S&P has declined by more than 20%, Wall Street earnings estimates for the S&P 500 component companies have remained relatively intact. In fact, they've actually been increasing. So, despite all this doom and gloom, are US companies actually on a good footing and the Wall Street analysts are to be believed? Or should we be expecting forecasts on the corporate profitability front to start to deteriorate? We'll dive more into this on a sector by sector basis later on, but for now, let's look at some potential scenarios for the market. Firstly, the S&P 500 does tend to swing around by its valuation. The high point came just before the dot-com bubble pop at 26.1 times, while the low valuation came during the heart of the great financial crisis at 9.4 times. Now, using current Wall Street estimates for S&P 500 earnings, I apply the historical data to see what range of outcomes we might expect if multiples continue to deteriorate. For example, if the market experiences the low of the century, 9.4 times, then that will put the S&P 500 at around 2350, implying a further decline of around 38%. Yeesh. Now, as I said, I don't expect things to end up anywhere near as bad as the great financial crisis, so perhaps a multiple reaching the 10th or 20th percentile is a more reasonable floor. That would put the potential future decline at around 10 to 18% respectively. Worth considering here though, is what happens if estimates actually start to drop off. In this scenario, I reduced Wall Street's 2023 EPS estimates by 15%. And as expected, things really start to fall off here. Here, those 10 and 20th percentile multiples represent declines of 23% and 30% respectively. Fingers crossed this doesn't happen. Now, an important consideration is obviously that the S&P 500 isn't just one thing. It's an agglomeration of many sectors with unique features which all have their own changes and expectations. As expected, over the course of the year, the traditional defensive sectors, utilities, consumer staples, and healthcare have performed relatively well. Well, on the other hand, the traditional highly cyclical sectors, energy, materials, industrials, financials, real estate, and consumer discretionary, have been more of a mixed bag. For example, going into most bear markets, energy companies typically don't outperform consumer discretionary by 80+%. Looking into the estimate changes on a sector by sector basis, a lot of this stuff does make sense. Oil prices have gone through the roof, so energy companies' estimates have been on a tear, and the sub-index return has reflected that. On the other hand, consumer discretionary companies have seen their estimates chop the most and have led the way downward. A few interesting things stand out here though. First, infotech has actually seen estimates rise, but is the third worst performing sector. This likely has something to do with valuations coming down to earth from historically steep levels as the hype waned, but it's still weird to see. Next is real estate and materials. Likely what's going on here is that while 2022 is forecast to be a banner year, investors have retreated as the future picture for these highly cyclical sectors looks murky beyond the current calendar year. Now, we can poke around the S&P numbers all we want, but ultimately the economic backdrop will be what decides how hard of a landing we take here. Is this a global financial crisis sort of economic event, or something a lot more mild like 2018? At the forefront is GDP. If the US economy keeps chugging along, likely few people will lose their jobs and will go on continuing to buy things, which secretly is what makes this whole world go around. The dot-com bubble, the great financial crisis, and the COVID pandemic have been the only true recessions in the last 30 years. US GDP came in negative in Q1 of this year, meaning that another down quarter puts us in a technical recession. However, Wall Street consensus is that we avoid this, and the outlook is for a solid rebound over the rest of the year. And all but one in the consensus see GDP growth coming in below 2% for the year. But we'll have to wait and see if this proves prescient or if the growth outlook continues to deteriorate. As for the Fed, even after an inflation situation that saw them obliged to hike rates by 75 basis points on Wednesday, they still see 2022 GDP growth coming in at 1.7%, albeit down from a 2.8% median estimate in March. Momentum is definitely swinging towards the downside. Now, inflation is currently the big concern to markets, having recently reached a fresh 40-year high of 8.6%. As with GDP, Wall Street currently has a glass half full outlook, seeing this tone down to 7% on the year and drastically falling off in 2023 and 2024 to more long-term sustainable levels. The Fed is even more bullish, seeing the 2022 figure coming in at around 5.2% for the year. Seems brave. And again, this has been downgraded from a 4.3% figure in March. I think the takeaway here is that the people in the world who should best be able to guess at this stuff all seem to think that inflation will moderate reasonably quickly, i.e. no stagflation, and that GDP growth won't take too much of a beating for it. I'm inclined to take this as a positive sign, but personally I think more downgrades are coming. It's just a matter of how bad and how persistent. So those are the biggies in my eyes, but I'm still going to speed round some other economic stuff. First, US housing is still in demand. Yeah, prices are still too high and mortgages are more expensive, but builders seem to see potential, with housing starts continuing to rise. The offset here though is that lumber has taken a bath on expectations that housing slows down, so who knows? Just food for thought. Housing is definitely going to cool off, but how painful that will be to the consumer is another question. Next, consumer confidence appears to be rolling over. How much of that is people feeling inflation, or is it even more broader economic woes? Again, who knows? But in my experience, when this stuff goes from one side of the 100-point level to the other, it usually carries with it a bit of inertia. As I said above, people buying stuff makes this whole crazy machine run, so if consumers are getting worried, things could get worse quickly. Following that, the US labor market is still pretty intact, pushing at all-time lows. If we see cracks opening up here, that is definitely a means of concern. And finally, I don't know if you guys noticed it, but the oil price is pretty high lately. Production has been slow to build back following the Russian invasion. US refining capacity is basically an inside joke at this point, and the EU is gunning for a near complete ban of Russian oil exports by year's end. Pretty ugly situation, but it seems like greed is the big underlying issue here. From the refiners to the shale guys to OPEC+. No one really seems super invested in lowering the price because, well, profit. So that's my thinking on the bottom. To tie it all together, I think first and foremost, the state of the US economy is what drives this thing from here. And the price level and valuation will be contingent on all of that. Like I said, I'm very confident this isn't another 2008. I was there, it was scary, this isn't scary. The economy seems to be on a good footing, but that will continue to erode until we see glimmers that inflation, the Fed, and oil are starting to normalize. If we dodge a technical recession, which the big brains believe that we will, but I'm not too certain, and we start to see some indication that inflation has cooled off, which I believe we will see sometime this summer, then assuming the rest of the economy hasn't completely blown up by then, this could very well be the catalyst for investors to get excited again. On the valuation and price front, as I said, this isn't the GFC or the dot-com bubble. Those were times when a lot of things were broken, important things. I don't think that's the case right now. Compared to the other big market pullbacks, yeah, things are probably worse, but we've already surpassed them all on the downside sans the COVID market blip. To me, the current situation has a lot more in common with 1998 after the Asian and ruble crises and 2018 during the rate hike fiasco. And arguably, the US is heading into them on much better footing. In both cases, the S&P 500 shed less than 20% versus the great financial crisis down 57%. If you think the current situation is somewhere in the middle of these, that puts the bottom at around a 38.4% decline, which I think will end up being conservative. But this means that the S&P could still see another 17% decline from here. However, an important consideration for people sitting on the sidelines is how the market tends to react coming out of big market corrections. In the 126 days following a bottom, roughly 6 months, the market has returned an average of 30.1% from the 6 big pullbacks in the last 30 years. Investors may not want to be fully invested, but having some money at work and nibbling in during opportunities will likely end up being the superior strategy to waiting for a bottom that has long since came and went, along with all the upside. Alright, so that's all I got for today. I hope you enjoyed it, and if you did, please give this video a like and consider subscribing for more informative and hopefully entertaining financial content. I'm Ryan, and thanks for tuning into Market Lab.